Good morning, everyone, and welcome to the fourth event in the CULS ESG webinar series, kindly sponsored by Savills. My name is Kotecha, and I'm co-founder at Amro Real Estate Partners. We're a real estate investor focused on the residential living sector, specifically on multifamily and student housing in the UK and in Iberia. Last year, we launched a new vertical looking at investing in prop tech startups, so real estate related technology, which I now lead as in my role as head of venture investments at Amro. I am also a CULS committee member, and I'm pleased to be your moderator for today's session. Today, our discussion is centered on green finance and the role that finance can play as a catalyst for addressing environmental and climate-related risks in the built environment sector, but also more broadly, and especially in the aftermath of the pandemic, how we can become a more resilient sector. We have an excellent panel with us today who I will introduce shortly. Just before that, I will go into some housekeeping and say that we are recording this event and it will be available to you in a few days via the Savills website and also via the CULS website and our YouTube channel. And the other bit of housekeeping is that we would like to end the session with a live Q&A discussion, and we welcome all your questions in the Q&A field that you will see at the bottom of your screen. So if you could kindly put your questions in the Q&A rather than in the chat function, that would be fantastic, and we'll pick up from there. So moving on to introducing our panel, we have four fantastic panelists today with a personal commitment to ESG as leaders of ESG in their particular organizations. Starting with Ed Dixon. Ed is head of ESG for Aviva Investors' $52 billion real assets platform. He leads the firm's ESG strategy across real estate and infrastructure investment, development, and asset management. Ed has 18 years industry experience and most recently held the role of Sustainability Insights Director at Lansec, joining the business in January 2016 to lead the integration of the company's sustainability strategy through its research and governance functions. Ed is a recent graduate of the Sustainability Leadership course at Harvard in Boston, and he also holds an MBA from Cass Business School. Welcome, Ed. Alexandra Njagulj is Global Head of ESG at CBRE Global Investors and has overall responsibility for developing and communicating global sustainability priorities and strategies across the business. Sasha, as we know her, is a qualified architect with over 20 years of experience in architectural design for sustainability in the built environment. In 2017, she joined CBRE Global Workspace Solutions as their lead for CBRE GI and has been responsible for designing and delivering ESG policies for country-specific and global funds. Prior to CBRE, she was head of sustainability at Breed UK. She holds a master's degree in sustainability leadership from the University of Cambridge. She serves on the GRESB Advisory Board, INREF ESG Committee, and the ULI Sustainability Council. She was the recipient of the 2020 GRESB BREEAM Individual Leadership Award. Welcome, Sasha. Emily Hamilton has spent the past 13 years working on ESG with a focus on advising and promoting sustainability in the real estate sector. Emily joined Savills Investment Management in September 2020 and is head of ESG globally at Savills IM. Emily was a board director at the Better Buildings Partnership from 2017 to 2020, is a trustee of the National Park City Foundation, and a mentor at the charity Heart of the City. Emily is a full member of the Institute for Environmental Management and Assessment and holds an MSc in Environmental Science and Society from UCL. Welcome, Emily. David, who is our invisible participant, and I'm not sure why we can't see David, but hopefully David is there. David, can you confirm that you are somewhere? Anyway, I'm going to introduce you and hopefully you can join us. David is Managing Director, Origination and Sustainability real estate, housing, corporate, and institutional coverage at Lloyds Bank. He has over 15 years of experience working for the two largest lenders in the UK, RBS and Lloyds Banking Group. In his current role, David is responsible for driving the sustainability focus for Lloyds, and his involvement dates back to 2016 when they closed some of the earliest loans under their landmark Green Lending Initiative, and subsequently made a deployment of circa £1 billion under that initiative. Since then, he has been involved in new credit strategies, including the launch of the Lloyds Bank Green Building Tool. David is currently at the University of Cambridge, where I imagine the Wi-Fi is not as good as in some other parts of the UK. Cambridge needs to do something about that. Where he's taking a master's degree in interdisciplinary design for the built environment. And he's also a member of PPF's Sustainability Committee and the UK Green Building Council's Whole Life Carbon Steering Group. Welcome to all the participants. And in order to first kick off the event, I would like to just set the scene by saying that ESG, and we were just discussing this before we went live, has become a mantra across various asset classes, including real estate. At the last count, there was $40 trillion of funds that wanted to be qualified as ESG funds and that would like investments in ESG qualifying assets. Equally, the Net Zero Asset Owners Alliance, that is led by the UN, has now accounted for approximately 5.7 trillion of AUM that is committed to net zero going forward. So clearly there is a huge amount of demand chasing ESG qualifying assets, and equally there seems to be an environment where pledging and building action to become Paris aligned is growing in spate within the built environment sector. David, if I may start with you. David is just joining. If I may start and kick off the discussion with you, David. Hi, David. If you could start off just by defining what is green finance and sustainable finance, what are the differences that we need to know about? And how do you see it from your perspective as a lender in terms of where we are now, vis-a-vis where we may have been about 3 or 4 years ago?
Okay, super. Well, thanks for bearing with me. I've literally just joined, so it's great to come in on time with the first question. So I think on a really simple level, and I think you referenced it in my introduction, when we launched our Green Lending Initiative back in 2016, it was a pretty sparse playing field. The green loan principles were only set up and published in 2018. The sustainability-linked loan principles were only published in 2019. So when you go back sort of 5 years, there wasn't tons of stuff in this area. However, with the publication of those documents, we have seen that increase over time. And you sort of fast forward to now, and actually we're seeing a sort of proliferation of both issuances in the bond markets, but also sort of structures in the loan markets. And I think just to recap on a really basic level, and a lot of these terms are used very interchangeably, which is great because it means lots of people are talking about it from different backgrounds, but it can be a bit unhelpful. So on a really super basic level, sort of green loans and green bonds, really, you're talking about the loan being used for a particular qualifying green purpose. So that's super important. So the proceeds are being allocated. So in a real estate context, that's for green buildings or the ownership or financing of green buildings, however that's defined, and also the development of those green buildings. So that's the green loan, green bond tranche, or part of the market. The emerging, I mentioned sustainability-linked loan principles 2019, and when you look at the graph, this is the sort of fast-growing area, and this is actually at a corporate level or a portfolio level where a company or borrower is raising financing. For the use of purpose is general corporate purpose. But then these are being tied to a corporate or asset level set of KPIs, or as they call them in the principles, sustainable performance targets. So that's just a crucial differential. But it's the latter that we're seeing really start to drive a lot more volume in the market currently.
Thanks. And would anybody like to add to that sort of definition of sustainable finance before we move on from your own perspectives?
I think it's important also to differ between ambitions and actual performance. And that is something that sort of happens with SFDR. For example, the Article 8 will speak about portfolios that promote ESG, but it doesn't actually state any thresholds for performance. Whereas EU taxonomy is coming up, will have specific thresholds in order to qualify. So there is that as well.
That's very interesting, Sasha, and it's really important that you bring up SFDR because it's come into action starting last month. And from what I hear, it's all encompassing. So it takes in all sorts of financial market participants, everybody from pension funds to venture capital and everybody in the middle, including financial advisors. And interestingly, it also asks for disclosure on assets that are not sustainable. So it's basically covering, it's all encompassing, it's basically making financial disclosure for climate very central to everybody's thinking, isn't it? From that perspective, and if I could move on to you, and obviously you recently grabbed headlines with the 1 billion pledge to originate green debt for sustainable real estate at Aviva Investors. Are you able to share something around that decision, how that came about, and how you expect to roll out and deploy that capital, given what we've just talked about in terms of the definitional approach to sustainable finance?
Yeah, sure. Thank you. So the Sustainable Transition Loans project really started probably at the beginning of 2020, and our real estate debt team, who are incredibly efficient and very forward-thinking, I think they saw an opportunity in the market. I mean, as David pointed out, sustainability-linked lending, it isn't new. It's been around for several years now, and there have been a lot of big moves in the market before us. But I think last year we saw that there's a point in the market where typically smaller organizations that are accessing unlisted debt want to engage with finance in a way that is structured, and they want to be rewarded for the moves that they make within their own portfolios. So I think through conversing with organizations and borrowers that we're working with, we realized that putting some structure into place and actually working with companies in a much more structured way would actually be quite easy. So the market was ready. I think the commitment itself was really just based on business planning. So what we thought we could achieve in a reasonable time frame. But I think at last count, we're almost at $500 million. And, we made that commitment in December. So it's a huge, huge step forward from the market. What I would say is that after we'd made the commitment publicly, we saw a really strong response from borrowers. So a lot of companies came forward to us and said, we're planning to roll this on our portfolio. We've got ideas to do bigger and better and to do more. And we'd love to work with you to be incentivized to look for even more opportunities. So the response from the market has been absolutely phenomenal. And I'm really hoping that we'll be able to deliver on our target early and then set an even more ambitious target for the future without trying to drop the real estate debt team in it. But yeah, it bodes well, certainly.
Fantastic. That is absolutely incredible to hear that you've got a commitment in such a short time for half of that amount. I'd love to come back to that, Ed, to go into a bit more detail about the framework you've created there for enabling that momentum. But before I do that, I'd like to turn to Emily, if I may, to ask you, Emily, from your perspective and from your understanding about sustainable finance, and you were at Grosvenor before you were at Savills, you came to Savills. If you could help us just unbundle some of the risks that we are talking about here. What exactly is sustainable finance trying to address in terms of the adaptation and transition risks? And if you could explain that in a bit more detail for the benefit of the audience, that would be great.
Great, thanks, Amy. I think one of the key things that sustainable finance is looking to unlock is this point that Sasha mentioned about performance. So historically, a lot of sustainable finance, i.e. green loans, have been linked to certification. So if you've got a BREEAM excellent building, that's how you can say it's a sustainable linked loan. But what we need is much more focus on performance. So we need to understand what's the energy performance of that building, what's the specific climate risk that could be hitting that building, whether it's through flooding or forest fires or heat stress, or it could be actually more to do with the transition risk, which is what we're talking about in terms of legal or market risks. So things like energy performance certificates, or the fact that SFDR is coming into play, and that might mean that companies need to be much better at disclosing. So what does that mean for your assets? And so there's quite a lot of different pieces at the moment, but what we're seeing fundamentally is that the climate crisis is front and centre, and it's helping to sort of unpack that through focusing on performance rather than just benchmarks and certification. That's the biggest shift I think we're seeing now.
Fantastic. And if you could just give us, perhaps, Emily, if you could give us some examples from your work at Savills in terms of how are you approaching measuring that risk or measuring that performance that you're talking about. And clearly there isn't an industry standard yet. There isn't a global standard. There is, and we're talking about these risks being addressed by investors from different parts of the world who are investing into the UK and vice versa. So what's the sort of benchmark that you're looking at, and how are you implementing that?
And there's numerous sets of different benchmarks, because I don't think anyone set is just fit for purpose. But like many of the real estate companies, we're looking at the Carbon Real Estate Environmental Risk Monitor, which is, or CREM, which is helping businesses or asset managers to understand what is the stranding risk of their asset. So CREM looks at both the carbon emissions of a particular asset, and it also looks at the energy intensity, so how much energy a building is using, and then using lots of complicated, very clever modelling by some brilliant people and researchers from various different universities. What CREM has managed to do is come up with global benchmarks saying this is what buildings should be performing at if we're going to decarbonise the economy strong enough by 2050. Like any benchmark, it's still emerging, there's still lots to do. So I think using CREM is important, but also things like the TCFD framework, so the Task Force for Climate Change Financial Disclosure, and particularly focusing on understanding what's the risk to the assets, but also to your business as a whole. So we're looking at both the corporate risk and assets under management. And that's things, again, like forest fires, flood, heat stress, all the things that you're seeing happening right now in Australia, in Europe, in the US. So I think there's various different benchmarks. There's GRESB as well, which is a global real estate environmental sustainability benchmark. But really for us, it's about getting under the skin of these benchmarks and not just taking them at face value to say, right, you've got a BREEAM excellent building or BREEAM outstanding building. So what does it mean in practice and how are we performing? And that's where we're seeing the industry head pretty rapidly.
Excellent. And Sasha, just to build on that, from your background, and you have a sort of broader, more global approach to this in terms of what you're doing at CBRE. Is there a portfolio level perspective that you'd like to share?
Well, GRESB is very much portfolio level, so it will look at across the entire fund or separate account, whatever you might look at, and then you have underneath that a series of certifications. Emily's mentioned BREEAM. Across the world, you have a whole host, LEED, neighbors. It's quite a smorgasbord of certifications, which is sometimes challenging, but also gives you quite a lot of options in the local markets. What we try to do is exactly the issue is between the theoretical performance of the building, that might be certified, if you like, at the construction stage, and then you sort of have your BREEAM excellent building, but how it actually performs might be quite different. So there is also a whole range of operational certifications where you actually look at ongoing performance of the building, and they give you a much better picture. So while GRESB or CREM even, all of these tools are desktop tools, so we see them only as a heat mapping exercise. So it can tell us not exactly what's happening in the building. It says, okay, well, there is an issue. This building is not decarbonising, or it's going to be stranded in 2030. But why is that exactly, and what needs to be done for that building? You have to have boots on the ground. You have to have an engineer on site And it can be part of a green-induced assessment where they sort of look at various aspects of sustainability and not only the energy performance. And they really tell you, okay, well, this particular building in this particular location, with this particular use and size and so on, this is what you need to do. And it could be anything from, you need to install solar shading, you need to recommission your building management system and your plant, you need to replace your windows, improve insulation, it can be a whole host of things. And that is where we really need to focus on. And of course, when you have a massive portfolio, we have well over 2,000 buildings, you need to start somewhere and some logic. And this is why we use CREM to do that heat mapping. So to say, okay, this is where the theoretically highest risk is, and the highest value at risk, most importantly. That's where we're going to start first. And then sort of chip away at risk in the portfolio, in an organized manner. So it's, you can't replace people on the ground, looking at a specific building. Every building is different. You need to keep that in mind.
Fantastic. That's great. Ed, again, coming back to you with what you said about the momentum that your offer for green debt has generated, and the sort of interest in sustainable real estate. I mean, from your perspective, from the broader sort of real assets perspective, clearly there's a difference there between these performance criteria for buildings and commercial real estate, infrastructure. There's a difference between private debt and private equity levers. Could you unpick a bit of that for us here, so that we can actually get a broader understanding of sustainable finance and the different levers, if you like, that are applicable to debt, equity, core value add, etc.
Thank you, Ami. Yeah. So I think if we go back to basics, the term ESG was really born out of finance, right? And it was born out of the relationship between asset managers and companies, trying to look at the E, S, and G factors about a company's performance that would be material in terms of their financial outcomes. Now, that term has been sort of exploded and has grown to just refer to almost the sustainability movement in finance. But really, ESG is a kind of technical term to do with risk. Now, if we look at the broader relationship between financial services and financial market participants and the companies and the assets that they interact with, ESG serves the relationship between asset managers and companies very, very well. You have perfect information, you have non-financial reporting, information is issued in annual reports. Asset managers are able to understand that very quickly using quantitative methods. But actually, when we look at private markets, anything that's unlisted, which is the area that us as built environment professionals, this is the area that we play in, there's a huge variety of different asset classes, as you say, that all really need a very, very different approach when it comes to ESG and risk, or when it comes to impact, or when it comes to becoming sustainable over time. So I think if we think about private markets and real assets quite broadly, in debt, really, whether that's infrastructure debt or real estate debt, the way that finance interacts with the borrower it needs to be quite specific, and it needs to be active. So the Sustainable Transition Loans project that I talked about and green lending that David talked about before, some of these methodologies are active and some are passive. Green lending might be just lending against a green asset. So the money goes out, it goes against a green asset, and that's a green bond or it's a green loan. Sustainable lending needs to be much more active and much more structured than that. And it needs to be through the form of incentives, where the borrower is being incentivized for certain activities. Or perhaps what we see more commonly in infrastructure is covenants, where the lender is actually putting a restrictive covenant into the transaction to make sure that the actor on the other side is actually perhaps not increasing their carbon emissions. So it's really like a carrot and stick approach. And there's a good example, it should be on our website somewhere, I can post it in the chat, of a deal that we took on board with a huge utilities company in Europe. And in infrastructure lending, you're usually lending as part of a consortium, right? So big ticket sizes, we're talking 400-500 million a pop, with lots of lenders coming to the table at the same time, which makes it really difficult to lend in an active way. But actually, if we put a restrictive covenant in place, which meant that the utility company needed to phase out their use of lignite, which is a derivative of coal, and that they needed to report back to us on an annual basis to demonstrate how they were doing it. Now, that's really, really important because it's active lending. It's a restrictive covenant that actually puts something active into place to mean that there's something from that financial instrument that's actually taking place after the loan has been placed. So I think it's really different between real estate and infrastructure. I think when we also think more broadly about infrastructure, we need to think about private equity. And this is where we're dealing with companies, small unlisted companies, where we might be buying directly into their management structure. And that's a different challenge again, because it's very much about getting that company to perform. And often if they're at the smaller end, perhaps they're growing quickly, they won't have big sustainability teams that can deliver, huge suites of different reporting. They won't have platforms and data. They'll need a little bit of hand holding, a little bit of support. So that's super broad. There's also even more exotic things in the world of real assets like forestry and agriculture. And again, there you're dealing with very specialist providers, typically that can have quite a large market share. And it's much more of a partnering approach where financial services need to find the right providers, the right partners, but then work with them in a much more gentle and long-term strategic way to create the right outcomes. So I think when we're talking about finance and we're thinking about ESG, we're thinking about private markets and real assets, we always need to be thinking about what's the instrument and what different lever do we need to pull for each different instrument.
Fantastic. That's really interesting. And you mentioned nature-based strategies, and that has become very core to the discussions these days around ESG. And I can imagine that it's not one to easily monitor and measure against. So that is an interesting hurdle. So coming on to that, I mean, clearly performance, disclosure, all of these, and you just mentioned restrictive covenants, all of these could be seen from the borrower's perspective as barriers to green finance. I'd like to open it up to anybody on the panel really who wants to take this up and talk from your perspective about what you consider to be the main barriers today and how those are being tackled, either through regulation or just through better collaboration, industry-wide collaboration through some of the industry associations that are leading on the sustainability front. So happy for any one of you to pick this up. Who would like to go first?
I've got a quick answer on that one, Ami.
Great.
I think for everyone listening today, some will no doubt be experts in finance and will be experts in sustainable finance, I'm sure. For the people that maybe aren't or don't consider themselves to be, what I would say is that your company, irrespective of what size it is, whether it's listed, whether it's unlisted, whether it's a small private company that's growing, whether it's family owned, it will more than likely interact with finance in some sort of a way, right? You're either going to be accessing commercial mortgages, or you might be accessing development funding. You might be accessing listed debt. If you're a little bigger, you might be issuing listed equity. And I think across all of those different areas in which companies engage with financial services, I think there really are a lot of opportunities. So yes, I think there are still barriers, but I think the market is so ready now for finance to engage in a really structured way that is win-win on both sides, for borrowers or for developers or for companies, to make the money that they access, whether that's in debt or equity, to make it really work for them. And I think the products are out there to incentivize companies and organizations to be able to benefit from the work that they do. So I know that there are barriers, but I also think that the market is really ready to change very quickly now.
That's tremendous. And clearly, like you rightly pointed out, looking at this as an opportunity is the way to deal with it. And Mark Carney has mentioned that a number of times in all his speeches, to say that this is the biggest opportunity of the century. So we ought to take it. David, you had your hand up, and yeah, I'd like you to make a contribution there.
Yeah, sure. So, we speak to a lot of different companies of different scales in different sectors. And I think the key barriers that I see is just getting your data in order to something that Emily mentioned, and it is all relative to what Ed mentioned, to the size of your organization, but you kind of need to know what you're looking at and what you've got. And actually, if you're struggling with that, it comes back to the point you mentioned, Ami, about collaboration. And I think, you know, no one party or one organization or one discipline has all the answers to this. So I think they're the barriers, is a sort of bravery really to just get involved and start trying to work it through, because unfortunately it is a really technically complicated area. There are trade-offs, there's no, you know, shortcutting the maths, you know, you need to get into that. But I think they're the barriers I see. And I think the other barrier is there's a lot of focus on incentive. So there's lots of discussions around discounted finance, which I find interesting because it kind of suggests I can only do this if you make it cheaper for me, which kind of sort of suggests that the societal and environmental impacts need some extra boost really to get that done. And I find that quite interesting. But I think the other barrier for me is thinking of it like greening of finance rather than green finance. And the reason I use greening of finance to some of the questions, actually, this talks to a future state of a screening out of counterparties and assets, because Emily mentioned things like stranded assets. There will be, and someone asked in the chat, you know, how will we embed this going forward? In a future state, you will look at some counterparties and say, actually, you're not quite getting this. You're not demonstrating, you know, a sustainability strategy. Therefore, there might be a time where actually credit appetite, we're not talking about, you know, cheaper discounts. We're actually talking about relative or absolute flows of credit for some of these counterparties, and then transitional finance as an important part in there as well, relative to those organizations. So they're the sort of barriers as I see it. But it's really, you know, how can we mobilize much more mass change and activity? Because, you know, it is great that the volumes are increasing, but it is a very low base. And someone asked in the chat, you know, what percentage? You know, it's going to be a very low percentage. CRE debt has a very challenging time on data visibility anyway, but there isn't a huge data set out there to assess that.
Okay, fantastic, that's interesting. And it's very interesting that none of you have mentioned that there is just simply as a barrier a lack of bandwidth. I mean, you know, just a lack of understanding or a common thread of conversation, or asking the same questions from the lending and the borrowing side. So that's really positive that no one has come up with that, unless somebody has a comment to make on that.
Well, I was going to say that, you know, there is no standard. So every single loan that we have agreed, either way, as a borrower or lender, is a new negotiation, a new definition, what it actually means, and you know, how it's going to be, how the proof is going to be delivered, and so on. So you know, one good example is as a borrower, we have agreed with Amro for our European fund, which is focusing on logistics assets, and we have worked together to say, okay, well, you know, what are the indicators going to be for this particular portfolio that's relevant for logistics assets, you know, what it is that we want to achieve, and that they also recognize as the real performance. So we have anything between installation of PVs and actual on-site renewable energy generation. Then we have some, you know, certification criteria, like we have BREEAM and EPC. So it's a combination of things that sort of really spoke to both companies, and also for those specific assets made sense to go for. And then on the basis of that, we had margin reduction. So if no KPIs are achieved, you actually have a margin increase of 2 bips. And it can go down to minus 8 bips if we agree, if we achieve all 4 KPIs in a given year. And it was completely custom for that particular portfolio. And, you know, it was the first one for both bank and ourselves to sort of agree something like that. So I think it's it's not a barrier so much, you know, but there's a lot of learning that needs to, and development that needs to happen in the industry, and you know, ultimately hopefully get to some sort of a standard around what it's meant by a green loan and green finance.
That's interesting. And there's always got to be a first. Like you said, there's always got to be a first, and you've got to start somewhere. Emily, you wanted to say something?
Just linking to what Sasha said, I think as well, at the moment, it is still cheaper to offset than it is to be retrofitting these buildings properly, to be looking at this, and you can make it work financially. There are good business cases, but it has to be over the longer term. And if you've got real estate transactions, you might be holding a building for 2 or 3 years, or you might be leasing a building out to tenants, and it then is meant to become their responsibility, the occupier. We need to get very quickly to a market carbon price that actually reflects the price of carbon in terms of the greenhouse emissions that we're emitting. At the moment, we're not. It's much easier to offset than it is to address it. And I think that is actually one of the biggest challenges. The market needs to somehow find a way to increase the carbon price, and pretty rapidly.
Totally agree with you there. I mean, obviously, this has been an externality forever, and we've just gone ahead and not priced it in. We've left it to insurance companies to insure against the risks, and now we're asking the asset owners to internalize the externality and give it a price. And that includes giving all resources a price, carbon and any other kind of waste that you're responsible for, and creating a transparency around your supply chain as well, in order to really impact that price. So from that perspective, I mean, the fortunate thing is we've got tons of data in the world today. There's no dearth of it. It's about making sense of it. How do we actually, what do you think the mechanics are? And then this is not, rocket science, I suppose, because the oil industry will have done it by now, and the mining sector will have at least approached it by now. How do we go about properly pricing in carbon and environmental resources into our financial modeling?
Well, I was going to actually, we had a comment in the chat which is not visible to all of the participants. So I'm going to just sort of summarize it. The issue of actually building more sustainably has an upfront cost, and that we are not seeing that being reflected in valuations. And in general, valuations tend to look backwards, and this is a relatively new phenomena. So even now, they're still not properly valuing future risks and future costs, especially including carbon taxes and climate risks and so on, that are a little bit more exotic than flood risks. And I think the valuation industry really need to pick up and look into this. Learn from insurance industry, I think, to really value this properly, and then it will obviously help all the players in the field to act properly.
David, I see your hand raised, and I'd also like you at the same time to start talking, if you don't mind, about pricing, because before we're almost coming up to time before we start on our live chat Q&A, and we wouldn't do our audience any service if we didn't talk about the differences in pricing and how you see that changing again over the next few years. So please pick up on any comments and go into that.
Yeah, sure. And it neatly sort of links into what I was going to say, actually. So if you go back to when we started with the Green Lending Initiative, we were offering up to 20 basis points discount on margins. And they were really a blend of green loans and sustainability-linked loans. We had a methodology that we used. And actually, we weren't inundated with people coming through the door. So we did £1 billion of lending between 16 and 20 on that programme. But to Ed's point, we have either closed or are mandated on 2 billion in Q1 and Q2 this year. So it just shows the trajectory of activity in this market. But, to the point that Sasha raised, I think in sustainability-linked loans, the market observable transactions are between 2.5 to maybe 5 to 10 basis points spread. And it's a two-way ratchet, like Sasha mentioned. So if you don't hit certain KPIs, you pay more. But if you hit them all, then you go down. These aren't a big corporate level. This isn't going to change the planet. These aren't huge financial numbers. However, when you overlay the questions people are being asked on TCFD, i.e., what will this asset be worth in 25 years' time? It's the market value and market rents that are really, in my view, going to start changing behaviour. And I believe, although I'm not a valuer or an agent, there is some more evidence, maybe Emily's got this, around some of the divergence of performance, particularly in the office market at rental level or rental pre-lets and stuff like that. I think in terms of pricing direction, there's a lot more evidence in the capital markets, or at least in materials I've seen, around the greenium. So, issuance that's got a green or sustainability linked format, getting better subscription, get a better coupon versus its relative peers. I think what we're looking at in the future, and a lot of people in the chat have talked about capital direction, you'll see this sort of carrot and stick. And a lot of this topic is a super complicated topic. There isn't one answer, else we probably wouldn't be bothering having this. You'll see a mix of regulatory interventions, capital interventions, incentives. And I think what you might start to see is this concept of, a brown penalty. So actually a building comes to market, and actually in extremis, the investment market or the finance market says, I don't believe in the future of that asset, actually. So I just don't have appetite. Or you might find someone saying, actually, I want some conditionality around that asset. I need to see that you're decarbonising that appropriately. Or actually, I'm just going to have to charge more for that because there is innately more risk attached to the cash flows and capital values of that asset. So we are seeing, just to finish off, some more differential pricing based on sustainability linked profile in the loan markets. And Tasha mentioned, the SLL sort of ratchets and stuff. We are seeing that creeping in. And I saw a number of people in the chat who are from an SME background, and they'll be pleased to know there are more simplified ways of accessing that, because it's important that we have a just transition. We don't just have big companies who are accessing these things and SMEs just don't have access. So there are some more simplified measures out there, acknowledging it's still quite a tough topic.
Fantastic. That's great. So in essence, we've got to be innovative on the financial side to actually start looking at, like you've all said, it's all nuanced and it's really driven by every single such situation. It's not one size fits all, and that's very clear. And on that point of browning, obviously, come 2050, a lot of the stock that we see today is going to fall into that regulatory category of needing to be greener, at least, if not totally green. And retrofits, therefore, take center stage in everybody's thinking on this. What are then the basic principles of how you incentivize people to make that transition to greener? I mean, we talked about, Emily mentioned a little bit about how the conversation with eventual occupiers becoming very important. And David, you mentioned about how greener buildings will potentially perform better in terms of rents. So in terms of finance, and then this whole approach of incentivization, if you can give us some kind of examples of where you have had this conversation, where you're encouraging people to take on retrofit investment rather than treat it as a cost, to take it on as a long-term investment in that building, and especially post-pandemic, when we're seeing a massive fallout in commercial real estate and repurposing potential for real estate that's now being discussed. Isn't that becoming very central and important? I mean, that addressing that whole kind of retrofitting and repurposing activity from the screening perspective.
I can take that one. So we've got some examples within our portfolio in terms of going back to David's example of the London office market is one that is seeing a green premium, particularly in terms of voids. So you're seeing much less voids and buildings are being let much quicker. So I think that's one really important incentive. It's not always yet the valuation side, but it is the void, and that means that then has an impact on the capital value overall. In terms of retrofitting, we're working with some of our clients to undertake net zero audits to look at what will it mean to retrofit that building, and trying to then demonstrate that in relation to the overall value. So on one building in particular, the value of the retrofit work is around £100,000, and that may sound like a lot of money, but the rental roll is 1.3 million. So when you can start to put that into context over 10 years, how much that actually means in practice, then we're starting to kind of see much better practical links of what this might look like in practice. I think it is very tricky because it's just a bit of a wild west out there when it comes to what is a net zero audit, and that's something I think the industry need to work on as well, is how we standardize that. But it's trying to show that actually in relation to the overall value of the building, these works may seem a lot, but they're not over the longer term. And that's what we've got to get to. But it's how you then could pass some of that cost on to occupiers. So it's not all the landlord fitting the bill as well.
Yeah, I think just to add to that as well, I think the retrofit challenge, particularly in real estate, raises some really interesting questions about fiduciary duty, because what we're really looking at here is a lot of short-term pain, a temporary hit from capex, which also hits your valuation, to really protect values in the long term. And we're only really just at the point where the tools that we have available to us are able to articulate what that potential downside might be over a defined period. So it's only just becoming possible for asset managers and companies that are managing real estate assets to be able to really work it into their analysis. But I think it's really important to think about how, whether asset managers and companies managing assets, what level of responsibility they take. Because we could look at the assets that we hold and say, right, well, we think it's really important from a kind of societal perspective to refurbish all of these assets now. Or we could take a more hardline approach and we could say, well, actually, our clients' interests year one, under the sort of more traditional view of fiduciary duty, is actually the most important thing. So actually, any assets where we see downside risk over a 5 or a 10-year period, we're just going to divest those right away. And we already know, from what's happened over the last couple of years, that what happens to those assets when they fall out of the hands of larger companies. It's smaller, perhaps private wealth, unlisted companies, some foreign investment that is lapping up those assets, particularly in central London. And there's a question over whether smaller private companies are the right companies that are going to take those assets and manage them in the right way and ready them for the climate transition. So, you see this happening in shopping centres, for example. So I think there's a big question there about whether asset managers should take the responsibility now, refurbish those assets and find a value opportunity, protect clients from downside risk, but also be aware of that the market is changing very, very quickly, and that in some cases it will be the responsible thing to do to keep your client's interests at heart, to divest. And I think we're going to have to be realistic about that.
Does anybody want to add to that at all? Before I move on to, I'm conscious of time and we need to move on to live Q&A. It's been fascinating to discuss the whole range of issues around barriers and incentives. And I'm really feeling positive actually at the end of this, that there is a lot of interest from borrowers, but there is equally a very credible answer and ready solutions from financiers who want to do this. So which is wonderful. And there definitely is a strategy forward on that basis. If I could start now with the live Q&A to take in some of the questions from the audience, if I may. David Roddick has posed a question. Green finance has gained traction on climate risks quickly in the last few years after years of inaction, but nature-related risks have advanced on the inside track remarkably quickly and are inextricably associated with climate risk. France created legislation making disclosure of nature risks mandatory last month. How long will it take lenders to recognize and internalize these risks? Who would like to take that? Anyone?
I guess as a lender, I might as well.
I was going to say, David, it might have to be you.
To go, but my background actually is in wider sort of social focuses rather than just carbon. And what I've seen happen, not just in real estate, but in other sectors. Obviously, it's about materiality, right? So real estate, carbon is a material impact that real estate has on the world and due to energy consumption. Other sectors have different, when you look at heat maps of ESG, I know some people don't like that sort of topic or that phraseology, different sectors have different focuses. So what we're seeing is a sort of spread really of where people are focusing their times, and TCFD laid the groundwork for TNFD, if you see what I mean. So a bit like you said about something's got to be the first, I think TCFD sort of gave a pathway for something like for nature-based financial disclosures. However, there's a whole heap of other topics without wanting to sort of scare people off. Obviously social impact is on some people's radars as well. So I think just to give you an example, we have developed an ESG tool, because I think someone in the chat was asking, when will this go into capital, when will this go in pricing? We have launched an ESG tool where we're rating all counterparties in all sectors. Still early days, but we'll continue to build that out. So we'll start to see ESG come into sort of credit ratings. Hopefully that gives that a bit of a go.
Absolutely. There is another question from an anonymous attendee asking, Relating to bandwidth and knowledge of existing CRE teams, and from an operational governance perspective, how important is it to have an internal ESG team or lead? Do you see that as being really key to driving the discussion forward?
You're asking the wrong panel here. We're all heads of ESG, so we're not going to put ourselves out of business.
No, Sasha, I think that the person is asking much more from a borrower's perspective, I guess, or an issuer's perspective. But my answer to that would be it's always important, isn't it? I mean, leadership is everything when you want to actually change something in an organization. That would be my obvious answer. But if anybody wants to add to that.
Yeah, I was just joking, but yeah, absolutely. You know, and the fact that you're seeing more and more companies appointing in-house teams, and of course, nothing, you know, not everything can be done by an in-house team, but it's important to coordinate and to lead the way. So yes, it's very important.
I do think it's also important, though, that we're upskilling asset managers, transaction teams, finance, HR. It needs to go beyond the ESG teams, because even if you've got an ESG team of 20, you may have a business of 3,000, and it needs to be a responsibility of everybody. And so, yes, you know, don't want to do ourselves out of a job, but we do need to be transferring that knowledge. I think the industry is starting to do that as well.
I would also add to that to say that for people in the audience listening today that are perhaps in more senior positions, or they're in smaller organizations where they're in control of hiring and where they grow their organization, what I would say is that, you know, becoming a sustainable business it brings competitive advantage, and it's an arms race now. You know, if you've got access to the best data, the best tools, the best staff, the best talent, you're going to gain competitive advantage from it, whether it's through your product or whether it's through reducing downside risk or, you know, seeking new market opportunities. So it's time to tool up. It really is an arms race at the moment.
And sorry, I just like to add for the SME audience, because I can see some people have mentioned that, you know, ambition and capability is all relative. I think a simple starting point is saying, okay, we've got tons of budget and hire loads of people. Let's start with just allocating someone responsibility. And it goes back to something Emily mentioned around, you know, climate change. Yes, obviously, clearly has lots of risks. These are opportunities too. These are development opportunities for people. These are business opportunities. So, you know, I just start small. And also it's about priority and focus. You know, if you've got a small number of people in the business, can this be a board level decision topic? You know, so there's small changes you can do that don't cost the world. However, you know, I would just say, you know, collaborate as much as you can externally, because, you know, these matters have been considered quite broadly, right? With a lot of Googling and a lot of seminars, there's actually quite a lot of stuff out there that won't cost you hundreds of thousands of pounds to get hold of.
Yeah, and I would just add that it's important not to see the in-house CSG team as the start and the end of ESG. You know, and Emily already said, you know, the entire organization needs to upskill. So the in-house team can help with that, and obviously can focus day in, day out on ESG. But the days where you know, in our industry, you don't know about ESG or sustainability, how the asset performs and all that are gone. Whether you're an asset manager, a property manager, or developer, you need to learn about this, and fast.
Fantastic. That's a proper call to arms, Sasha. Thanks. Dominic Riley has asked either Ed or David to pick this up. Do you foresee a lending environment in which all loans, not just those in green lending programs, will have a financial incentive in the way the loan is priced, triggered by good ESG behaviors? And I think this is a very important point that we haven't had time to touch on today, which is social value, social capital, and governance related issues, the S and the G essentially. So Ed, would you like to pick that up?
Yeah, I think David's actually probably already covered it, really, because I think what we're hoping is that in the long term, these topics will be understood well by the lender, and they'll be just simply rolled into credit analysis. So an organization that has a better handle on its own operational costs, perhaps through its utility and energy costs, an organization that has better governance, you know, perhaps looks after its staff in a better way, is going to be a better organization over time. And as these data sets grow for unlisted organizations, I think it'll be easier for larger lenders lenders to be able to work out the good guys and the bad guys, and work out, you know, who is a better proposition. And I think that will ultimately lead to this sort of carrot and stick approach hopefully fading and becoming something that is just worked into core analysis. I do think, though, that in the short term, to stimulate the market, incentives in whatever form are always something that's proven to work, and we see it happening for things like electric vehicle infrastructure at the moment, heavily subsidized, so we're seeing a huge explosion in that market. 6-7 years ago you saw the same on solar. You'll see the same in a couple of years' time on hydrogen, I would expect, where subsidies, government subsidies, market incentives from financial actors are starting to really stimulate the market, and then as the market grows and matures, we would see it start to roll into core analysis, which will mean that market forces will take over, better companies will be rewarded for better practices, and the poorer companies will be punished.
That's great. And there's a very important question, actually, that we haven't addressed head on really in today's discussion so far, which is about return on investment and the whole conversation around good growth, and whether we do actually need to be achieving the same levels of return going forward, and if that in any way is does a disservice to our wanting to pledge to be green. So the question is, green projects in some sectors have slowed down significantly since the reduction or removal of FITs, suggesting fits. I forget what that represents, the government's subsidy. Yes. Suggesting that a large part of the industry was driven by return and not green desires. Do the panel find the most projects that receive lending are driven primarily by return on investment? And is there a minimum return that they as lenders will require in the business plan? So this is obviously the trade-off between return and doing the right thing. Does anybody want to address that? Or is it something that you leave to asset owners and borrowers to actually figure out for themselves in order to make it all work?
Quickly come in on that one. I think something like feed-in tariffs has clearly been enormously successful in stimulating the solar market and driving prices down. Prices for PV have dropped through the floor, and that's why we're seeing huge rollout. Now, obviously, with the feed-in tariffs fading away, I would say that institutional and long-term investments, money that's seeking to be locked away for 10, 20, 30 years, that's probably starting to move away from it now because the risk profile is slightly different. But then, what we have seen is the corporate power purchase agreement market starting to really be stimulated purely because the cost of PV panels has fallen. So what I would say is that incentives like feed-in tariffs can attract bigger money because of the lower risk profiles. Bigger money crowding into the sector can then help to drive down prices and stimulate the market. And that actually has the desired effects that the market needs over the long term. Now, that does, of course, raise interesting questions about what were the objectives of the long-term money that was investing into that sector. And of course, they're partly financial and they're partly more societal. But the fact remains that incentives do work. And if we see more incentives of that nature in the future, then it will hopefully start to attract the right sort of investment, which will stimulate markets, drive down prices. And I'm hoping that we'll see this in green buildings, new types of clean technology, air source heat pumps. That's another example. If they were incentivized, that would stimulate the market, bring in long-term capital, and that's going to really drive the numbers, help to push prices down.
Thanks very much, Ed. And I hope that somebody from government is listening to this, so we'll send them the video later to make sure that they've heard what the panelists said. Thank you all so much. We're running out of time. We could have talked about this for another hour at least, if not more. You're all fantastic panelists and have contributed so candidly and openly. I'd like to thank you very much. But to wrap up, I hand over to Ian Marcus, our president of CULS, who will say the final words to end the panel. Thank you very much, everyone.
Amy, thank you very much. I'm a great fatalist. Halfway through the webinar, the postman arrived and delivered my copy of Mark Carney's book. I'm sure some online will say I should have read it online rather than ordering a hard copy, but either way, I look forward to the read. Can I just, on behalf of the some 350 people that were attending today's webinar, thank our speakers for their informed, insightful and thought-provoking commentary. As a property banker for approaching 40 years, it's both refreshing and enlightening that providers of capital are at last recognizing that returns can be measured by more than just financial benchmarks, and their respective stakeholders now seem to accept and expect this broader social impact of their investments. And as Ed said, they can now be measured far more accurately. So can I thank Savills for their continuing support and sponsorship of this ESG series of lectures, with special mention to David Jackson and Roger Wheaton. Your engagement is hugely appreciated. And thanks to the popularity of this series, we're going to continue it into the next academic year, and the next event will be focusing on carbon sequestration and green technologies. And I'm very excited actually about the forthcoming events we've got planned by the Land Society. On the 19th of May, we have our annual CEO talk given by Stephen Boyd of the Government Property Agency. The 25th of May, we have a presentation by the CEO of the UK Antarctica Trust. And then, fingers crossed, on the 22nd of June, we'll have our third in a series of workplace seminars, which will include a real-life actual tour of 22 Bishopsgate. And having cancelled last year's event, we hope to host our AGM and annual dinner at Fitzwilliam College on the 7th of July. All these events will be bookable on the CULS website and very shortly, and we hope we can rely on your support. But more importantly, once again, a special thank you to Ed, Sasha, Emily and David for your fantastic contributions today. And of course, a special thank you to Ami, not just for facilitating the webinar, but for your vision and enthusiasm in putting this series of ESG seminars together. I hope you've all enjoyed today's discussion and wish you well for the coming weeks, with I hope we can all be together in person very soon indeed. Thank you very much and good morning.